Listen, most people are dead wrong about dividend stocks, and today we are going to talk about why. If I had to build wealth with stocks using one simple filter, I would never start with the latest hype or whatever some guy on social media is screaming about. Regardless of what the press says, I would start with companies that have paid shareholders through recessions, through inflation spikes, through market crashes, and through interest rates going through the roof. It is not because dividends are some kind of magic fairy dust, but because they tell us something incredibly important about a business. Let me hit you with a fact that most people never hear because it does not make for a good clickbait headline. Did you know that nearly 60 years of market data shows that high dividend stocks do not just beat low dividend stocks, they actually beat the full market over that entire stretch? This is not a random blog post or a guess. It is academic research. Researchers looked at the top 1,500 U.S. stocks by market cap from the years 1963 through 2021, and they split them right down the middle. They put the higher dividend payers on one side and the lower dividend payers on the other. Then they tracked the total compound returns over that entire period, and the result was not even close. The high dividend group did not just do slightly better, the gap on the chart was absolutely massive. $1 invested in the high dividend group grew to roughly 10 times what the low dividend group produced. I am talking 10 times the wealth just by picking the boring stuff. So when somebody tells me that dividend stocks are boring, my response is always the same. Boring compared to what? Losing money. I will take boring money over exciting losses every single day of the week. Now here is the part that really matters, because the researchers were not saying that dividends themselves have magical powers. Their conclusion was that the outperformance came from the type of companies that tend to pay dividends in the first place. We are talking about high-quality, profitable, stable, and defensive businesses. And my response to that is the whole point. If dividend-paying companies tend to be the kinds of businesses with stronger discipline, stronger cash flow, and more durability, why on earth would you ignore that? That is why I use these types of stocks first in my infinity investing framework. I am not chasing excitement, I am building a cash flow machine. If you hear people yammering about the 4% rule, you might want to ask them why they would buy an asset with the expectation that they will be forced to sell it later. Think about it. If you have to sell your stocks to pay for your life, you might be forced to sell at the absolute worst time. Ask anyone who tried to retire in the year 2000 or 2008 how that worked out for them. It sucked. After working with tens of thousands of investors, I have realized that being forced to sell your assets is a position of weakness. I want to live off the income my investments produce, whether that is dividends, option premiums, or interest. I do not care what you call it as long as I am not forced to eat the golden goose. I just want the eggs that the golden goose lays. That is the real difference between how most people are taught to invest and how smart investors actually think. Most people are taught to chase appreciation first, hoping the price goes up and thinking they will worry about income later. They build portfolios that look great on paper, but when it is time to actually use that money, they have to start dismantling the machine. I do not like that model at all. I do not want to build a pile of assets just to slowly liquidate it until there is nothing left. I want assets that kick off cash while the pile continues to get bigger. I want to get paid while I still own the company. The truth about dividend stocks that nobody tells you is that the dividend itself is not the magic. It is the business behind the dividend. A dividend does not make a bad company good, and a high yield definitely does not make a stock safe. In fact, that is where a lot of people get punched in the face. They hear about dividend investing and immediately search for the highest yield they can find. That is not a strategy, that is just yield chasing. Yield chasing is how investors walk straight into a trap. If you see a stock paying a massive 10 or 15% yield, your first question should not be how much income can I get. Your first question should be what is broken here. The market does not hand out huge yields for free. Sometimes the stock price has collapsed because the business is dying. Sometimes the payout is not sustainable because they do not have enough free cash flow. The yield is often just the bait used to lure in investors who do not know any better. In my framework, the dividend is just one filter, not the whole story. I want quality, I want durable revenue, and I want businesses that people still need even when the economy is falling apart. I want discipline in management and a reasonable valuation. We actually use 7 different criteria for any stock we buy. The dividend is only one of them, and we are not even looking for the highest yield. We just want to see that it is at least 2% and that it has been sustainable for at least 10 years. I am buying quality companies that happen to pay me while I own them. That is a huge distinction. and that is why I start with stocks first, not real estate. Now, do not get me wrong, I love real estate. Real estate is my second engine. It gives you leverage, tax advantages, and depreciation, but real estate is operational, and it is way less liquid than stocks. It takes more work, and it can be dangerous if you do not know what you are doing. Just ask anyone who bought a property and had to put a new roof on it 2 weeks later. Stocks are cleaner, they are liquid, and they are much easier to automate. If you build the right portfolio, you get a growing stream of income without getting a midnight call about a leaking roof or a clogged toilet. After stocks and real estate, I like managed portfolios and ETFs where I can allocate capital to experienced operators, and then I keep about 10% in a reserve of cash, or cash equivalents like gold or Bitcoin. Why? Because markets change and volatility creates opportunities. I always want some dry powder and some flexibility. That is how you build a real financial life. Not just a portfolio. It is a system. The stock portion of that system needs to throw off cash. That is why dividend growth investing fits so well. I am not trying to impress people with paper returns. Think of it like this. If you had a portfolio worth $1 million that allowed you to retire and never work again, would you really care if the market value went up or down by 40% as long as the income stayed the same? The value is a distraction. The income is the focus. The best version of this is owning a company that pays you today and has the ability to pay you even more tomorrow. That is the part people miss. When you own companies that have been increasing their dividends for 25 or 50 years, you are buying inflation-protected cash flow. That is how your portfolio becomes an engine that never stops. Just look at Warren Buffett. He did not become the greatest investor in the world by rapidly buying and selling every week. He did it by holding high-quality investments and letting them kick off so much cash that his biggest problem is finding new places to put it. When you layer in reinvestment and tax awareness, you have something incredibly powerful, because at the end of the day, your return is not what you make, it is what you keep. Structure matters more than most people realize. The market delivers the returns, but your system determines how much of that money stays in your pocket. After taxes and mistakes. This is also why I never isolate one asset class. Stocks are the first engine, real estate is the second, and managed strategies are the third. Put them together and you are no longer dependent on one thing. You are building multiple streams of cash flow that support each other. That is what real wealth looks like. A lot of investors go wrong because they skip the core and jump straight into complexity. They chase growth and alternatives before they have a solid foundation of income-producing stocks. They buy things that are complicated because it makes them feel sophisticated. But simple things done well will beat complex things done badly every single time. Building a portfolio of high-quality businesses that pay you consistently is not flashy, but believe me, it works. It is about building a repeatable framework that creates income, protects your capital, and gives you choices. When people ask me why I like dividend stocks, the answer is simple. I like getting paid. I like owning businesses that give me cash without me having to sell my shares. They are the foundation of a life where your money works harder than you do. If you know someone who is still chasing hot stocks and hoping for a miracle, share this video with them. Drop a comment below and tell me what companies you think belong in a real cash flow portfolio. Give me your favorite ETFs that produce consistent cash. And if you are not subscribed yet, do it now. I put out new videos every week on investing, tax strategy, and asset protection. Before you go, I have 2 free gifts for you. First, I will give you a free copy of my book Infinity Investing. Just type free book in the comments and I will send you the link. Second, if you want to learn about tax and asset protection, we teach a free class almost every Saturday. We have been doing this for 30 years and you can join us as my guest. I will put that link in the show notes for you. Go check out my other video that went viral while you are at it. Stay boring, stay patient, peace.